So, how can we use leaps to push our portfolios to a value quicker so that we can get to passive income levels to live that fire lifestyle sooner than later? I'm going to talk about how we can use leaps to build that passive income so that we can quit our jobs and retire and live the life that we want to live. Stick around, this should be a really good video. Hello, my name is Adam Kahn, and this is Investing with Adam K. Hope everybody's doing well. Today I'm going to talk a little bit about using leaps and the value that they have. I'm also going to talk a little bit about crypto, what I like to do with it, not to try to push that portfolio higher to get us to that passive income level and live that fire lifestyle that I know so many of you would want to. I mean, the reality is why do we all do this? I think it's all for the same reason. The reason we're on YouTube searching these investment videos, trying to find ways to beat the markets and do better. So I think we all have this desire to build our portfolios to get to a point that we can retire and we can live off dividends and live that lifestyle that we were always hoping. Now, one thing is to do your own analysis of how much money you need, figure out what you need coming in to be able to do the calculations to know how much money you actually need to get to. There are strategies to try to get there quicker. Now, like everything else, I don't mean to always talk about the negative, but there is legitimate risk in this that a lot of people on YouTube tend to not discuss. They really just talk about the benefits and how easy it is, oftentimes even talking about how it's just free money. But part of why I did the video the other day about the portfolio that I've been trading in is to show that things don't always work the way that it's planned. They do go against you. You do have tough rides, and it doesn't mean there's any guarantee of success. They brush over that and just talk about how you can make millions. They also talk about how they can make 80 or 100% return year in and year out consistently with no risk. Well, I call BS on that. That's just not realistic. Markets have risk. The more risk you take is how you're going to get paid off. And the reason I wanted to talk about the leaps is what I recognize as much as I'm getting to the older stages in my life and may not want to take on as much risk as some other people, some of you are a little bit younger and might be willing to take on that risk and take some shots and not worry so much about the negative side of things. I just want to be clear about them, which is why I always say, this is not financial advice. I really mean that. Please, by all means, you need to do your own research, reach out to a financial advisor, and you shouldn't be listening to me, and you really shouldn't be following anybody else's advice on YouTube either. You have to make your own decisions when it comes to trading, and maybe you get some good ideas on here, because to be fair, there are plenty of people I've listened to that I followed some of their suggestions. Some have worked out, some haven't. I've just been trading long enough that I'm okay taking the losses when it doesn't work out. But I do see people in the comment section oftentimes saying, hey, I took your advice on this. It isn't working the way I think, and blah, blah, blah. And a lot of times it's a reasonable comment that oftentimes I notice that the person who did the video doesn't even respond to them. Now, I wouldn't think much of that if they weren't responding to anybody, but I do see them responding to other people. So I feel terrible for those comments. And I hate the idea of people making those mistakes. But the strategies that they implement, they aren't always so bad. So I don't want to be so negative on it all the time, comparing it to roulette and blackjack the way I was, as much as I was joking around and being kind of sarcastic. But they have a lot more risk than just set it and forget it. And if you're not patient to just set it in dividend stocks or things that are a little bit more conservative, it's okay. So let's talk about that strategy and the advantage and how it can work to really push you forward, maybe get you to a point where you can live a fire lifestyle, maybe teach you some strategies that potentially you weren't considering. And we'll start with leaps. And what are they? Well, first, let's not get confused or thrown off by the fancy term called leaps. A leap is just a long term option. I don't know why they've changed the name. It's kind of stupid, but it's any option that has 12 months or more until expiration. Whoa, super fancy leaps. And then some people buy a leap for like a call option, and maybe they even sell shorter dated calls against it to try to generate more income. Now, you have to talk to your brokerage company, see if they allow for that in your account. Some of them have little safety things that won't allow you to do those. They'll let you buy the call typically if you're set up for options, but they may not let you sell one against it. And if you get taken on the one against it, all you have to do is exercise the one you were long, early, which you're allowed to do if you're long a call option or even a put option. The reality is you can exercise it anytime you want. And the reason people might do that. So the reason I tend to say it's not a great idea is people don't always realize it's a way to be leveraged. It's a way to take on more risk. Here's why you might use a leap. So I was looking at Amazon to use somewhat actual numbers or pretty accurate ones. Amazon closed at 231 or $232 today when the market closed. I looked at December of 2027, so more than 2 years, $180 call. Well, it's already $50 in the money, so you're with me so far. The cost of that call is around $80 per option. It's 100 shares for each one. So for the same $24,000 approximately that a person would have to put out to be able to buy 100 shares of Amazon, you could potentially buy 3 of those options. They give you more than 2 years. They cost $80, so you've put out the same $24,000. Forgive my bloopers. I know somebody said they like seeing them. Anyway, you've put out the same $24,000 to buy these leaps. And now, if the stock goes higher, now your break even, 80 plus 180 is 260 to where you've covered the total cost of what you spent on the leaps. But to be fair, at that point, you're long 300 shares. I mean, you are the whole time, as opposed to the 100 if you bought just 100 shares of stock. And you have a nice long time horizon that this could potentially be realistic. I'm still bullish the market. That's why I said I don't want to be so negative on this stuff. I think the market's going higher, and Amazon reaching $260 a share isn't that big of a stretch in my imagination. And quite honestly, I could see it there by middle of next year. I don't picture Amazon as this big high flyer, but I do think they tend to outperform the market. And when I looked at the pricing of the leaps and did my analysis, I do see some value in it. Now, part of what they say in their videos is, well, you just have to make sure to pick a stock that's going higher. I'm not saying Amazon is. I am not making any guarantees. So when you come back and say, now, you did this, you bought the leaps based on my suggestion, it is not my suggestion. I am just showing the advantage of it because I do see some value in using some of these strategies. So if they fit what you're trying to do in your accounts, and you want to push a little bit harder and use some leverage to your advantage to try to get to where you want to be quicker, that's okay. The risk is if you're wrong and if Amazon struggles, you're risking the entire amount of the money versus if you buy the stock, you're really risking what the stock goes down in value, because I think we can all agree that it's highly unlikely Amazon's going to go to zero in the near future. But if things take a rough turn and we're buying it at the wrong time and the market has a correction, I don't think it's so out of the world of possibilities that we wake up in 2027 and somehow Amazon is only trading at 140 or $150 a share. I don't think that would be the case, but if it did happen, you would lose all $24,000 for owning those 3 leaps. Now, on the flip side, if it does do well and Amazon ends up around $320 a share, which I think over 2 years is a possibility, I think it's a little bit of a stretch. I mean, honestly, I think it could perform at maybe 15% a year. If it's trading 230, you're talking about maybe $30 to $40 a year. So maybe $70 over the 2 years. So more realistically, let's call it 300. Well, you essentially spent 24,000. You now have made. Sorry, I had to pause because even my brain was getting a little confused and I had to think a minute about where we actually were with it. So you've bought 3 of these leaps. You paid $80 a piece. Your break even was at 260. Well, 260 to 300, you have $40, 4, 8, 12. You've made about 12,000 on your 3 leaps. And if you bought the stock instead of the 12,000, you would have only made 6,000 or 7,000. Amazon's around 231, 232, like we said. If it's at 300 in a couple of years, you've made 70 points approximately. 7,000 versus 12,000. And you've done it with putting the same amount of money out. It may not sound like a huge difference, but it really is. You're talking about approximately, I'm just ballparking, I didn't sit down and do this, but outperforming by about 70%. And I think that's actually a realistic scenario of what Amazon could do over the next couple of years. If you're lucky and it gets to 320, well, same thing. You're making 3 times as much from there than you would have by owning the stock. The other thing is, by having leaps, you don't just own the stock, you have the time decay, which on a long-term leap doesn't move very quickly. So it creates opportunity that if you get really lucky and the stock shoots up, whether it's Amazon or something else that you like, a good amount in a short amount of time, you may be able to sell those leaps and get out early and still have the extra premium that was in it because it might still have a whole lot of time left. The other strategy that some of the people are using with the leaps is, let's pretend it's working out fine. Remember, I said sometimes it doesn't, so I don't want you guys to sit there and say, oh, you told me it was free money. That is not the case. But let's say we did buy the Amazon leaps today. In 2 weeks, we noticed that Amazon has been really fortunate. It's already trading $250 a share. Well, maybe you look at some shorter term options and sell a 3 month out $270 call to collect a little bit of premium in the hopes that the stock hasn't quite gotten above 270 and you got to collect that premium, and no matter what you get to keep that either way. And if the stock does go through it, well, maybe you don't sell all 3 of them, you sell one, and you have to release 100 of the shares. Now, I know I mentioned a little bit early, you can exercise your option if you're long it at any time. Now, if it's against you, why would you do that? There's just no reason. But some people will exercise an option if it gets through the strike price early, simply because they don't want to wait it out or take the risk that the stock falls back down or anything else. And instead of selling the option, they'd rather have the shares. So they exercise that option, which is why it's an option. You have the right to do that early. Just means a phone call to your broker. Let's say, a year out, Amazon has done incredibly well and it's at $300 and you're still long these leaps that are an $150 strike price. You have the right to call your broker and say, hey, I'd like to exercise one or two or even all 3 of these options. Now, understand, if you do, when you're long those shares, you now have to have the money to be long them, so you would need the $90,000. You have the profit to use against it, and you only paid what you paid. But that's the other advantage of the leaps, is you don't need quite as much money in the account to wield a larger position, which is why I say you're leveraged with it. Now, to be fair to the people who talk about them, that's why I say there are some advantages to it. It is not all bad. But I'm going to say my disclaimer again because I want to address it, because I am an old fuddy-duddy and I worry about these things because in my life, since I'm old, I don't need leverage anymore, and I transition to less risk, less leverage, more stability, more protection. It's just the life cycle of investing. So I think I'm a little oversensitive to the negatives, and I point it out a little too often. But it is risk that I don't want to see people lose their money and look to me thinking, hey, you told me to do this. It bothers me how easily a lot of these guys go on YouTube and just say, sell puts. If you have the money, there's no risk in it, or do this strategy. And it's a lot of risk. In fact, I know I talked about the yield max. I wanted to explain these a little bit more so that people really understand the risk they're taking. I'll use Amazon. So $230 a share, and they do this on a weekly basis. So what they'll do is buy next week's $230 call. If the stock goes up, they're able to exercise that and be long the stock, right? Everybody understands that, I think. We understand calls and puts, hopefully, and how they work. What they'll also do is sell the $230 put. When you sell a put, I know it's easier when people think about buying, but selling is the opposite. So if you buy a put, it gives you the right to sell the stock at that strike price, right? So if you sell the put and the stock goes lower, the person who has the right to exercise and sell the stock at that price is going to, forcing you as the seller to have to buy the stock. Does that make sense? I know it got a little confusing there. So if you've sold the 230 put and Amazon falls lower, you're going to be forced to buy the stock at $230. This is what's called being synthetically long, because in both scenarios, you're long Amazon. Stock goes higher, you're going to exercise the call. Stock goes lower, the other person who you sold your put to, they're going to exercise it, and you're going to be forced to buy the stock. Synthetically long. Now, why would you do that as opposed to just buying the stock? Aha! The reason is typically an at-the-money call and the put are going to have the same value. So you shouldn't have to put all that much money out. You may even get a credit depending on how the market feels the direction of the stock is going. And to be fair, if there are dividends or things like that, that'll impact it as well. But the reason to do it is instead of putting out the $24,000, I've now, or 23,000 if it's 230, I've put out zero so far. So how does your firm even let you do this? Well, what they're going to require is the account to have a certain amount of margin to have on that position. And if it's an institutional investor, they're probably negotiating around 25%, but that's just a guess. I don't know that for sure, just as somebody who's dealt with risk analysis. Now, the more volatile a stock, the more they'll require for the margin, but then they can do one of a couple things. They can do it more than just the one for the same stock, meaning if I had to put out 24,000 and I only have to hold 25%, geez, I could do up to 4 of them instead of just the one, right? Understand? More leveraged, everything else. The other thing is somewhere in between, maybe I only do 2 of them, so I am a little bit more leveraged, I have a little bit more risk on, but I can take that other $12,000 and I can invest it in treasuries and get some sort of a yield return on my money at the same time. All makes sense so far? So what they then do is they then sell a quote unquote covered call against the call that they're long. Here's the problem with that. Now, that's where they're collecting their money to be able to give their distributions, not dividends. I'll apologize now if I end up saying dividends. So we bought the $230 call. Maybe we sell a $240 call for this week. Maybe even it's as tight as a $235 call to get a nicer premium. The problem is I've now capped my upside. If Amazon shoots higher, the call that I've sold against the calls that I'm long is going to limit how much I'll make on the trade. So my best case scenario, which is still a good trade, is my 230 call. I exercise it because the stock goes higher. I've sold a 235 call against it. Maybe I collected $1 or $2 for that. And the stock is now above 235, so I've capitalized $7 per share. Well, if the stock is at 250, which I know is an extreme move, but it can happen every now and then, I haven't collected those other points for the distance that the stock moved. I sold it at 235. Yes, I got an extra $2, so I sort of sold it at 237. But any amount that it's higher than 237, I haven't made where somebody who is just long the underlying stock would have. They don't do anything on the other side to the downside. So if the stock falls, you have the complete risk of being long the stock. Now, they do have the option to cover the calls that they sold against the original call and sell lower ones to try to get a little bit more yield and make the dividend or distribution bigger. But again, they're lowering where they're going to get out if the stock reverses and then goes higher. These funds are really dangerous. I understand it's super attractive because of the yields that they pay, but in a down market, you're going to be long the stock, and in an up market, you're going to limit your upside. The only way it ends up perfect is if you're, in this example, buying the 230 call, selling the 235 call, and Amazon is ending every week the equivalent of being 234, so that you optimized, you made $4 in the stock, you collected that extra $2 for selling the other call, and now you can even sell a higher call and maybe it works out perfect. I just think that's a lot of luck that you need for it to really go your way. And in any corrective market, you're just going to get crushed. That's what I don't like about those funds. Now, again, I still think that there are reasons to be able to use these strategies. I even think selling long-term options can be valuable. I kind of looked at it in the opposite way of, geez, if I sell a call that's like, if the stock doubles over the next 2 years, well, how much do I collect for doing that? And if I'm owning a stock anyway that I don't plan to do anything with for the next couple of years, maybe that call has enough premium in it to make it worth selling. Anyway, that was just something I was looking at. But you can use these strategies to try to get to the point where you build your accounts faster, to have more money, to invest in safer stocks and get the dividends and live a passive lifestyle, which I think, like I said, to be fair, is really the goal that we all have. Now, one of the guys who I really like, and I love a lot of you guys, but was asking about crypto and my thoughts on it and so on. So I'll show a little of how paranoid I really am as I talk about it. And he was curious, do I think you should have ETFs? Do I even invest in it? And so on and so forth. Yes, I do have some crypto. It is 99% Bitcoin. I do not buy ETFs. I don't buy the other stuff. I want to actually have Bitcoin. And not only that, I am a firm believer in self-custody. I don't want to own Greystones or whatever, iBit or any of the others, because that's no different than any other stock. Like, to me, the whole point of Bitcoin is you're able to take it, put it on a thumb drive, and throw it in a safe deposit box, and it is offline. It is something that, like the guys who own gold or anything else, but man, it's just a thumb drive. Like, it's super cool. And I want to be the one who's in control of that. And then if you need to buy something from somebody else who accepts it, there are ways to do it that are totally offline. The negative is it's a lot of risk in terms of now you're responsible for your Bitcoin. Like, if it gets lost or anything else, it is gone. Like, you do have those things. But I also think that there's some value in the safety of it can't be hacked, that it can't be gotten to. Like, I worry that one day that Wells Fargo and Chase and JP Morgan are all going to get hit at the same time because the internet isn't as secure as we might think. I think blockchain is extremely more secure. And then I think having it off chain on a thumb drive is even more secure. I think there's some real value to that. And I think being able to put $100 or something on a thumb drive and hand that to somebody as a Christmas gift is a pretty cool way of being able to give something out without there being it going through Venmo or PayPal or cash or anything. I think the digital world, especially as we move to digital currency, that's a pretty neat way to be able to do things. And I think being off chain and on your own custody, at least for me, is really important if you're going to invest in crypto. I'm not sure what I think about having the ETFs. When I've read some of the paperwork on some of it, like, some of these have an ability to then create their own if they ever see something that they don't like about Bitcoin, which actually worries me a little bit about the dilution of it. If one of these huge funds decides that they don't like some fork that happened on Bitcoin, so they're going to start issuing their own that mimics it, have they just started issuing more coins somehow, or are they potentially pushing the market to try to manipulate it the way that they would like it to go? Like I said, you'll see how paranoid I am when I talk about crypto. Now, I don't really get into too many others. I used to, and I kind of kicked myself because I had some Ethereum and I see how well it's done. But what I worried about with Ethereum and some of the others is they have a lot of competitors. And While I feel like Bitcoin is kind of like the Atari of blockchain or the AOL of blockchain, I feel like it's moved far enough and built enough of a support system that I don't know that it's going to be like AOL, where in time there's just a better one. And why did anybody even have Bitcoin? I think at this point, people even associate the name similar to Kleenex with tissues, that they think of Bitcoin as crypto. Um, so I've stuck with it because I do think of it as digital gold. I do think of all those values. And when I look at Ethereum and what I've learned, the little bit that I have, because I really don't know a ton, I worry that something like Solana might overtake Ethereum. And those of you who don't know what these things are, the way they talk about Ethereum is it's like the gas that makes things move. Like if you wanted to have the equivalent of a website on blockchain, you tend to use Ethereum. Like that's the main base that helps the platform run. And anytime anybody does anything with your crypto that you've created, they have to use a little bit of Ethereum to make it work properly, which is what gives Ethereum value. The thing is, Ethereum is like a software that runs on the blockchain, and there's nothing in my mind that doesn't say that could be the AOL of that stuff. And I worry more about some of these software programs that there'll be others that come along that are faster, that are cheaper, that are better. I really liked Solana and I have a very small position in it, mainly because I saw that Visa was partnering with them to potentially run their entire system, which tells me there's something they see in Solana that's a real value. And what I've noticed is Solana moves extremely fast and costs less than a penny when you want to transfer it. That's a real value. And as somebody who used to own a restaurant and dealt with credit card processing and other things, part of why I see the value of crypto, like if I still had a restaurant, I would be thrilled if somebody wanted to pay in crypto versus a credit card. Credit card fees can run 4%. They're not just lying to you about that. And if you negotiate a good one, you're lucky to be in the high twos. And if you're at a restaurant that has small swipes, even if they're only charging 50 cents per swipe, if you're selling a soda for $2 or $2.50 and you're not Amazon or McDonald's or somebody who can negotiate that to be really aggressive and just be a few pennies, man, that's going to eat into your sales versus taking something like Solana that could be transferred in a couple of seconds and cost less than a penny, and you don't have chargebacks. Like it is what it is. It's done on the spot. There is no reversals. Like all of that stuff was just awful in the restaurant business, and I'm sure others have to deal with it too. I hated credit cards. The only thing I liked about credit cards is it meant that the staff couldn't steal. Like I see things that are negative with cash. So if you're able to implement crypto, what an advantage for all of these businesses to have instantaneous transfers of money. They don't have to wait 3 days for the credit card processing company to move it into your bank account. It'll happen immediately and it's done. There is no chargeback. The money is yours. Nobody can buy a pizza and then 2 weeks later say, oh, I didn't really do that. Send me the money back. And I'll tell you, I never won one of those cases. Even when the people were in the store, I had them on video. We swiped the credit card. It still went the customer's way when they said they didn't make that purchase. So there's so many advantages to crypto. Yes, I believe in it. It's super risky. I would not put any amount of money in it that I'm actually super concerned with. I think it's super cool. I just don't know how it's going to play out. But to answer the questions, yes, I do have a little, but no, I do not invest in the ETFs. I believe 100% in going to a Coinbase or a Kraken or whomever, buying a little bit, learning how to digitally send it to one of the thumb drive things. There's a bunch of different companies that can do it, and then put it in a safe deposit box at the bank so that you know it's safe there. The one thing I'd recommend is keeping a really good written down spreadsheet of what you paid and everything else so that you can do your taxes properly, because it gets very convoluted and you really want to make sure it's all in order to be able to report what you need to report. Anyway, that was a long time without even hitting like pause or stop and having to change things. Hopefully, I didn't screw up too much. Anyway, have a great Thursday. Markets seem to be acting really well today. I mean, we'll see as we go into tomorrow, going into the weekend. If you haven't already, do me a favor, hit that subscribe button, smash the like button, make some comments in the comment section. Let me know if you use options in your trading strategy. Do you use leaps? Do you have crypto? I love the conversations. I like seeing people get involved. Have a great day, and I'm going to do my best to get this posted. I'll also do my best to do another video tomorrow. Have a good day.